The decision to pursue a golden visa is a big one. Once you've made it, the next question is a practical one. Where does the money come from? For an investment of up to €500,000, understanding your funding options can be as important as understanding the investment itself. Today, we're going to break down the most common ways to fund a golden visa investment and explore the unique tax implications of each. There are a number of ways to access the capital needed for an investment or a cultural donation. The most straightforward, of course, are personal savings and the sale of other assets like stocks or property. These are often the easiest and cleanest options, though you still need to consider any capital gains tax from selling your assets and the tax impact of a golden visa investment itself. My video on U.S. tax implications gives a deeper dive on tax impact. Another option is to use loans. You may be able to get a home equity loan, a loan against your stock portfolio, or even a business loan. It's critical to note that interest on a home equity or business loan is only tax deductible if the loan is used for home improvements or a legitimate business purpose, respectively. Then, there's the question of using your retirement savings. Some people consider taking a loan from a 401k. While a 401k loan is possible, it has strict limits. You can borrow up to the lesser of $50,000 or 50% of your vested account balance. You must repay it at a reasonable interest rate, such as 5%, and the loan must generally be repaid within 5 years. While you cannot use your IRA capital directly for a golden visa investment, and do not believe anyone who tells you you can, you do have IRA adjacent options. First, you could take withdrawals from your IRA or 401k for this investment. If it's a traditional IRA or 401k, you'll owe taxes and, if applicable, early withdrawal penalties. If it's a Roth IRA or 401k and you withdraw only principal, you will have no tax due. Now, let's talk about IRA loans. Unlike 401ks, loans are not permitted from an IRA to a disqualified person. A disqualified person includes the IRA holder themselves, their spouse, ascendants, lineal descendants and their spouses, and business entities owned by any of those people. Any loan to a disqualified person is considered an extension of credit, prohibited transaction, and can trigger a major tax liability. Accepting loans from others via their self-directed IRA at market rates is perfectly legal as long as the lender and the borrower are not disqualified persons. Of note, siblings are not disqualified persons. Issuing loans to others from your own self-directed IRA is also legal as long as the borrower is not a disqualified person. For some families, the investment is a collective goal. Families can use what I call generational pooling of capital. In this strategy, the required funds are gathered from a group of family members. In Portugal's Golden Visa program, for example, 3 generations of one family can be included on one application. So one investment of €500,000 or a donation of €250,000 can include the investor, their spouse, their financially dependent children, and both sets of parents and in-laws. Taking a family of this size as our example, if each adult in the family contributed, that's the parents and both sets of grandparents, each would put in $100,000 for the fund investment or $50,000 for the cultural donation. That would raise $600,000, roughly equivalent to €500,000, the minimum for a fund investment, or $300,000, roughly equivalent to €250,000, the cultural donation benchmark. This approach can make the financial commitment more manageable for each individual. This can be done with personal savings or through tax-exempt gifts. U.S. law allows you to gift up to $19,000 annually to any individual without triggering gift tax liability. This provides a compliance-friendly way for family members to contribute. When pooling capital, it's important to consider fees associated with golden visa processes. See the video on cost breakdown beyond the investment for more information on what fees and costs to expect. Ultimately, the source of your capital is a critical distinction that should align with your financial situation and tolerance for risk. Each method has its own tax consequences and risks, and a decision on funding is a decision that must be made with eyes wide open. Remember, the Golden Visa is an investment in a desirable lifestyle and future optionality. Benefits available in the EU include low-cost and no-cost education and medical care. To understand how this all fits together, see my video on the freedom and mobility of a Golden Visa. And for a full education on how to navigate these financial decisions and all the risks involved, I welcome you to join the Don't Get Burned Golden Visa Risk Masterclass.